Okay, so now let's turn our attention to property as we make this run home. And so there's a few things we always want to look at. We want to look at lending because obviously that indicates demand and activity. We want to look at building approvals, and then we want to look at the ultimate, what's happening with prices for both houses and also for rent. So let's start also with the home lending activity and what we saw from the ABS. That the value of new home lending for owner-occupied homes in Australia grew by 2.8% month on month. To 17.48 billion in March. That's easily exceeding market forecasts of a 1% growth and accelerated from the marginally revised 1.5% rise in the prior month. Now, the purchase of existing dwellings also accelerated 3.5% versus 4.1%, while construction of dwellings rebounded 3.2% versus negative 1.7%. So there is some movement in construction. However, the purchase of newly erected dwellings fell 1.5% after increasing 6.2% previously. Now that can bounce up and down a little bit there. That's all about what's happening weather-wise and the completions that are going on. Now this is where it becomes really interesting. Let's have a look at this around the ground. Geographically, we saw new home loans increase in most states or territories. New South Wales 2.4% up, Victoria 2% up. Queensland, strong, 5.6% up. South Australia, 2.8%. Western Australia, very strong, 6.3%. Tasmania, small market, so you get these fluctuations, but 17.8% up. And the Northern Territory, 13.6%, again, very small market. Now, conversely, we saw a plunge of 19.2% in the ACT. Now, on an annualised basis, the value of new home loans has jumped by 11.4%. So some real activity, and we're seeing that in our business in terms of the number of people who are actively looking. In terms of building approvals, this is the biggest headache for the government with their targets around, this big build program that they want to go on in terms of building new houses. So we saw the ABS report that building permits year on year in Australia decreased by 2.2% in March from negative 5.3% in February. So there is a slight improvement in terms of month-on-month approvals. Remembering, again, this jumps around a lot. Seasonally adjusted estimate for total dwellings approved increased by 1.9% month-on-month to 12,947 units in March, reversing the upwardly revised 0.9% fall in February, but missing market expectations of a 3% gain. In terms of the markets, the strongest growth in 5 months with private sector houses, 3.8% up. Private sector dwellings, excluding houses, 3.6%. In terms of posting strong gains. In terms of geographical area, this is where it gets down to what's going on. So we saw dwelling activity in terms of approvals. Victoria up 3.2%, West Australia 1.5%, and falling in Tasmania, negative 18.1%, South Australia negative 7%, Queensland negative 5.2%, and New South Wales negative 2.1%. But again, those numbers do jump around. Okay, moving along to the CoreLogic's monthly hedonic home value index. And what did we learn from our good friends at CoreLogic? We saw that in terms of the April results, Sydney was up by 0.4% for the month of April. Melbourne was negative. It fell by 0.1%. Brisbane was up by 0.9%. Adelaide was up 1.3%. Perth was up very strong 2% in the month. Hobart was 0.3% higher. Darwin 0.6% higher. And Canberra 0.2% higher. So the only falling market across the country is the Melbourne property market. So combined capital cities, we saw a 0.6% gain, and combined regions, we saw a 0.8% gain. So nationally, a 0.6 gain. So some of the broader observations here, this is the classic case of markets within markets. So there's certain markets across the country that are doing really, really well. It's good to see also some of those regional markets. Now, that's really excluding the Victorian data. So some of the Victorian markets are quite sluggish at the moment regionally, as well as obviously Melbourne are suffering from headwinds around government policy and regulations that are going on down here. So you can really see, the markets are definitely starting to separate in terms of their activity. And it still remains, a strong supply versus demand story. So demand is definitely exceeding supply in most of those markets. So we see, Perth's flying, Brisbane, Adelaide very strong, Sydney, Darwin, Canberra are also solid. Hobart's doing okay, and Melbourne really is the underperforming market based on their economic management down here in Victoria. Again, what I was mentioning before, it's good to see in terms of from a regional point of view, excluding Victoria, that the regional market combined was up 2.1% over the quarterly period. So that is also telling us a story around most likely affordability. We are definitely seeing a bit of movement around migration, interstate migration away from Melbourne and also away from Sydney into those more affordable markets as we look at that. Now, let's turn our attention to the rental growth story, and I'll get your opinion on this in a minute, Evan, in terms of what did we see. So yesterday, CoreLogic released a report that says, for the first time, rents, weekly household median rents across the country have hit a peak at $627 in terms of that. So let's just quickly have a look for those who are on the pod. I'll also read them out. So we see Sydney's median weekly rent is $770. Melbourne's $589. Now I want you to hold that figure in your head. Brisbane is $649. Adelaide is $589. Perth is $669. Hobart is $547. Darwin is $617. Canberra is $674. So combined capitals really doesn't mean much, but $659. Combined regions $540. And the national is the reading I just gave you before, which is $627. Now, this is where I want to talk about. So Perth, strongest market in terms of rental increases, 13.6%. I expect that they will lose their title to Melbourne, which is coming in number 2 at 9.6% in price growth, because I've been telling you the story about what's been happening in Melbourne. There's an exodus of rental supply in Victoria and in Melbourne specifically. So we're down around 11,700 rental properties than where we were basically 3 months ago over the year-on-year result. So that's got to be concerning, and obviously that's going to put pressure on it. And that's why it's so interesting, because if you look at Melbourne compared to, say, Brisbane and also Perth, so you've got Melbourne with a sort of, a median house price of $942,000, but their rent's only $589. You've got Perth with a median house price of $754,000, but rented only $669, and you got Brisbane with a median house price $920 with rent at $649. So effectively, you've got a 10% discount on rents in Melbourne compared to Brisbane, and a 14% discount in terms of rents compared to Perth. So with this shortage of supply, I have no doubt, and obviously the land tax that's been introduced, which we're calling a tenancy tax, I have no doubt in my mind that Melbourne is going to see the strongest rental growth over the course of the next 6 to 12 months, purely based on the fact of there is just no new supply. Investors are moving across to the west, and also Adelaide, Southeast Queensland still remain very strong investor markets. Again, Perth and Western Australia, strategically brilliant by their parliamentarians over there to not introduce the no clause eviction notices. So that's attracted tens of billions of dollars of investment over into that particular market as well. And from a price point, relatively affordable and good yields. So when I see, and I think longer term, sort of the next decade or beyond, Melbourne's going to represent excellent value. But right now, you've got to be basically buying against the trend where all the demand is effectively heading over into the Western and also Brisbane markets and Adelaide markets at the moment. So that just sort of gives you a bit of an idea. Have you got a view on that, Evan?
No, again, the term that you always use is business owners, right? So if you are to impact business owners with higher taxation and higher changes in that space, you are going to have to see that surely but surely pass through. So on to your thesis, which is I completely agree with regards to Melbourne. That business owner, that landlord is going to have to pass those costs through. And it is unsustainable to have a yield that's below 2%, which is what you've just highlighted as well. Most properties at the moment are below a yield that is sustainable. So the business owner, that small player, is going to have to raise rents just because, not just the fact that they are clearly at a discount to regional peers, which they should be at or above. Let's also be honest, particularly around Brisbane and Adelaide with the population that Melbourne has over those two. So that is, the thesis is absolutely pretty clear. And then you've got the business impact that comes with having higher levels of taxation.
Yeah, and I think if we do tell a story over time that if interest rates do go up a little bit higher, there will be an insular sort of protection mechanism because of the supply constraints versus the demand. I would have thought if we were in a normal balanced market and interest rates were going higher, we would see property prices decline further than what they have. And in fact, as we know, they're obviously growing when interest rates have moved up as high as they have. So that's an interesting story. All right, let's now summarise basically what we've talked about today from an economic point of view. We've really honed in on the domestic driven inflation story, which is that sticky inflation. So that services inflation, non-tradables that Evan talked about there. We also wanted to focus in terms of, our prediction around where we think the cash rate will go. It's moved our estimate in terms of, when that first rate cut will happen. So my prediction was August. Evan's was September. We're now potentially seeing that later this year or potentially in the new year. Now, again, what's going to inform that is really the month on month, but really the quarter on quarter inflation data that we're going to see in June. That's going to dictate basically, where the RBA heads from there in terms of what that looks like. From a property point of view, I'll just continue to keep reminding, property investors are still doing it tough. There's lots of costs. Namely, we've talked about those interest rates. We've talked about the insurance premiums, the tax and charges, the increased compliance costs that are all coming into that particular space. And that's ultimately leading to a negative outcome for both the small business owner, but also the tenant that they want to have quiet and safe enjoyment of those properties as well. So they're my final words. Evan, something from you for your final word?
Yeah, so for me now, it's all about August. And why do I highlight that? Ben just pointed out, the June quarterly numbers, we will get that inflation read in August. And that's what will therefore inform our view around what happens for the rest of the year, because half a year's worth of inflation, the RBA will have a very good understanding then of where things are going. So that is why now that month is going to be absolutely core to everything for the rest of this year, because we will get so much data from the second quarter of this calendar year. And that's where we now need to focus our attention in terms of what will happen for the rest of 24, but also into 2025.
Well said, mate. And obviously, as you said earlier, we've got the federal budget coming up. So this is obviously fiscal policy. So what is the government going to do? They are torn. They've got an election that they want to re-win. So they're going to probably throw a bit of cash at it, which is stimulatory, which is going to be challenging against inflation. So you're going to do a special budget update next week. So we'll, keep an eye and an ear out for that. In terms of those updates, and we'll be back. So remember that the RBA updates now every 6 or so weeks, so down to 8 times a year. So we'll be back when the next RBA announcement, which is in June, for our next update for that. Until next time, always remember that knowledge is empowering, but only if you act on it. And bye for now, folks.